Welcome to Financial Modeling of a Startup series. In this video, we are going to model 3-year projected balance sheet using our case study. If you are new to this series, we would recommend you to check previous modules so that you have better understanding of the financial model. The link to the playlist is in I button. So hello everyone, my name is Karan Damania. I am an ex-investment banker turned founder, and through encoding careers, we help people build successful career in finance. So let's get onto the screen and start building our balance sheet model. We are using this template to model our 3 years balance sheet, where we have already completed our first year's balance sheet using previous video, where we understood in detail each and every line item of how that item is in the balance sheet. If you have not checked out, please do have a look at that video first and then come to this video to model out the next 3 years balance sheet. So we are going to go through each and every line items assumption to model out our 3-year balance sheet, and we have our presentation with us where we will understand what is the storyline behind each assumption. So let us first understand what are the items that we will cover. Number one is our expansion plan. In the previous module, we did understand about expansion plan as to where is Sandy planning to expand his outlet into. And we understood that in terms of profit and loss statement of what were the items in the expansion plan that would affect P&L statement. But now we are going to understand in terms of the balance sheet. Next, we are going to understand the CAPEX plan of the business. So CAPEX means capital expenditure, and how is the company in our case study going to expand their business using capital. So that is what we are going to understand in CAPEX. Next is our term loan, which comes on the liability side. What are the assumptions behind taking a term loan? Next, we have working capital, where we will understand the assumptions behind how a working capital is built for the projected years. And finally, we have retained earnings and cash, which will help us close our balance sheet. So let us start with the first point, that is expansion plan. In the previous video, we understood everything about the operation side of the business. How will it earn revenue? What are the streams? How is business going to expense out from the funding that we are receiving? But now we are going to understand the broader picture and go into detail of how funding is used to build out that structure of expansion. So let's go through the description. Expansion in NCR in year 1 and Noida in year 2. So that we already know that, since we have our outlet in Delhi where the property is owned by us and we are running our business over there. In year 1 we are planning to expand to NCR and open one of the outlet there, and in year 2 we will go to Noida to expand our second outlet. We are raising 20 lakh in equity plus term loans for support. So we will understand how this 20 lakh equity can be placed in balance sheet and how this term loan has to be mentioned in balance sheet. Next is assets, liabilities and working capital build around this growth. So based on the growth that we mentioned, that we are expanding to NCR and Noida, how can we build the entire business structure around that? So we are going to project that through assets, liabilities and working capital, and going to understand the storyline behind that. So let us start with the first point, that is CAPEX, where we are going to understand about kitchen setup and furniture. Because we are now expanding to two more outlets which are into blank space, we will have to set up our kitchen so that entire process can be organized and people can be served easily and in efficient manner. Next is we are going to need furniture. Since the space is blank, we will need tables, chairs, we will need fans, ACs to make it a place where people would be happy to come. So that is about kitchen setup and furniture. Let us go through each point. Existing, we have 1 lakh kitchen setup which is depreciated over 10 years period. Since kitchen can be used for long term, so we have attached a 10-year period of the useful life of kitchen. There are some assets which we need to depreciate in the short period of time, like we have furniture over here. We will understand that as we go through line items. So year 1 we have 2,25,000 for kitchen spending, and we are spending 1,20,000 on furniture and interiors. So this year 1 expense is going to be made in NCR's outlet where we are opening in year 1. And in year 2, when we go to Noida, we will spend 3 lakh for kitchen and 1,75,000 for furniture and interiors. So when we modeled our P&L statement, we saw that the year 1 outlet, which was in NCR, was a space of 300 square feet. So that is why the expense we need to spend on kitchen and furniture is bit less than in year 2, where we are opening in 400 square feet area in Noida. So that's why we have to spend a bit more on kitchen and on the furniture and interior part. And other way, if you are spending over periods, you have to account for inflation in your assumptions. So that is something you have to take care. And on the depreciation part, we have point mentioned kitchen is depreciated over 10 years period, furniture for the next 5 years. Since furniture is something which you will have to change on a regular basis because it is used very often and it does not have greater life, like if you purchase a fan or an AC, it will not run for very long because it is constantly in use. We will have to purchase new and this furniture will be discarded then. So let us now move on to our template and model out this capex plan. So we already built our fixed asset schedule in part 1 where we had 1 lakh of kitchen setup and 40,000 worth of furniture in our outlet, and the depreciation amount was 18,000. Now we will add the year 1 and year 2 assumptions to this. So in year 1 we are spending 2,25,000 for kitchen setup and the furniture is amounted to 1,20,000. So similar to the formula used for year 1 where we depreciated kitchen for 1 lakh and furniture for 5 years, we will copy paste this formula over here and we will just change this. Okay, so we have 46,500 as a depreciation for the year 1. Now this same depreciation is calculated for the next 5 years because we have furniture for the next 5 years with us, and after that we will only depreciate the kitchen setup. But since we are modeling out for the next 3 years, both of them will be depreciated. So we will just copy paste this entire formula for the next 3 years. So 46,500 is the depreciation in year 1, year 2 and year 3 for the new additions of kitchen and furniture. In the year 2 we are adding 3 lakh worth of kitchen setup and we are adding 175 worth of furniture and interiors. Now we will have to calculate depreciation on this asset. So we will copy paste the formula once again. We will change the sales of furniture and kitchen setup. That way we get 65,000 as the depreciation amount. We will copy and paste this in year 3. We have depreciation value with us. We have the assets addition with us. We now need to calculate the closing balance of fixed asset. So closing balance of asset equals to the opening value of the asset minus the depreciation amount for that particular year. So that way we will get the closing balance. In the year 1 we had 1,40,000 worth of assets and the depreciation amount was 18,000. We had closing balance 140 minus 18, that is 22,000, right? But now since we have added more assets in year 1, we will have to add those assets as well in our balance sheet. So that way the closing balance of previous year becomes the opening balance and the current assets will be added. After that the depreciation for the year will be subtracted and we will get the closing balance. So to make it easier, let's apply this practically. So this becomes the opening balance of year 1, that is 1,22,000, in which we add our fixed asset addition which is kitchen setup and the furniture, and out of it we will subtract the entire depreciation amount which is 64,500. So that way we get our asset as 4,02,500. Now we will copy and paste this formula in the next years. Perfect. So we have 7,48,000 assets in year 2 and the assets are reducing to 6,18,500 because we are not adding any more assets in year 3. So the entire amount of closing balance of fixed asset will go into the balance sheet and this depreciation amount will go into the P&L. Since we had not completed our P&L and we were left up to EBITDA margins, we will now complete the entire P&L alongside the balance sheet. So let's plug in the closing balance. So here we are going to copy paste this. So we are accounting for non-current assets. We are not adding separately the kitchen and furniture amounts. We will add the total closing balance of fixed asset. So the amount for year 1 was 4,02,500. Next year we will paste this entire formula. So 748 and 618,500. Perfect. So we now have added our non-current asset. We will go on to the P&L statement and add our depreciation amount for year 1 is taken from the fixed asset schedule as 64,500 and we will scale this to year 3. So this is negative, so we will just add a negative sign and paste it. Perfect. So we now have added depreciation and our fixed asset schedule. Perfect. Moving on to the next element, which is term loan for working capital. So let's understand the description first. Current loan 1 lakh rupees at 15% interest. So here we have fixed interest, that is we are only paying interest amount on the entire principal for the 3-year period. Since we have this loan for 3 years period, in year 3 we will have to pay our principal amount, that is the entire 1 lakh, which is what we have modeled already in our borrowing schedule. So the current year is already being modeled. In year 1 we are adding 1 lakh worth of loan amount and in year 2 we are adding 2 lakh term loan to our balance sheet. Here both the loans that we are adding in year 1 and year 2 are on reducing balance rates. we will understand how reducing balance works and how we can model it out. The purpose of adding a term loan in the assumption is to manage early stage working capital shortfall if revenue is delayed. So what the assumption behind this is, investors would ask you, why do you want to get term loan when we are providing you with equity capital? So to make them convinced that we are going to take term loan because we want to be sure that when if our revenue assumptions don't match up, then we are not in cash crunch, right? We have some working capital amount with us which we can use on the emergency side. Since the interest rate is around 15 to 17% for early stage companies, the growth rate that these companies have is more than 30-40%. So they are happy to pay those interest amount and manage their entire working capital in case the revenue earned is not as per expectation. The loan repayment principal in equal installment interest on reducing annual basis. Here it is mentioned that interest gets reduced on annual basis and principal is paid in equal installments. Here, like current loan, we cannot directly plug in the principal amount and calculate interest on it. We will first have to make a loan amortization schedule. As we have assumed that this loan will be for 3 years period, let us calculate how much will be the EMI that we have to pay on a monthly basis for these loans. For that, we will use this loan amortization calculator, where we will go on to this amortization calculator. Here we need to plug in the loan amount that we are taking. It's in dollar, but we can assume this as rupees. So here in year one, we are taking 1 lakh as our loan. Sorry, this is 10,000, this is 1 lakh. And we are taking this loan for 3 years period, and we are going to pay 15% interest on it. Now we need to press the calculate button. So here we have our monthly payment amount, which is 3,466 rupees, and the interest and principal division is given as below. So in year one, you are going to pay 13,092 as your interest amount, and your principal will be 28,505. This is on annual basis. If you want to see on monthly basis, we can press this, and we can see that in month one we are paying 1250 as our interest amount, which accounts to 15%. When you calculate 1 lakh rupees into 15%, you will get a monthly interest of 1250, which is 15,000 divided by 12. So first month you will pay 15% as interest rate, but since you are also paying the principal amount along with the EMI, your balance of principal is reduced. So from 1 lakh, your now principal balance is 97,783. Now 15% will be calculated on this entire amount, which accounts to 1,222. And similarly, you will pay greater principal than the previous amount because your AMI is same for every month. As the interest portion is reducing, your principal portion is increasing on yearly basis. So effectively, when you pay interest on reducing balance amount, the amount of interest that you have paid on the total loan is much less than when you pay on the flat basis. So here we see that the total amount of interest that you are paying in 3 year period is 24,795. But when you took loan for the year one of 1 lakh and you paid flat 15% interest on it, you paid 3 years of 15,000 amount, which amounted to total 45,000 rupees, which is pretty much high than the reducing balance interest rate, which is around 25,000. As we are making balance sheet for annual basis, we will take this amounts and plug it into our balance sheet. First, we need to account for the loan that is added, which is 1 lakh rupees. Okay, the principal amount that we have paid is 28,505. So this was principal calculation. This was for current, this was for year one, and this is for year two. Since we are not taking loan in year three, we have not added a line over here. So for year one, we are paying principal of 28,505. So 28,505.41. We don't want to miss out on decimal because it will give a bit of decimal error in the end. So that way we accounted for 28,000. The interest is paid 13,092.98. So 13,092.98. So that way we calculated the loan amount for year one. We will similarly plug in for year two and year three, where our interest is reducing to 8,510 and principal gets increased to 33,000. The total of the principal that you pay will amount to 1 lakh. So that we will see when we plug in the entire numbers. Perfect. So now we are ready with our interest and principal calculation. We now need to calculate the closing balance. So as we have mentioned that all the principal total will account to 1 lakh, because you need to pay the entire principal back to the bank or the company that you are taking loan from. So now to calculate the closing balance, we will have to add the opening balance of year, and we will have to subtract the principal that is paid in that particular year. In year 1 we have 1 lakh as the previous year's loan amount. We will add 1 lakh added in current year and subtract the principal amount of 28,505. So that way we get our closing balance as 171,495. In year 2 we are adding 2 lakh worth of loans. So similarly we will add 2 lakh over here. To calculate principal and interest, we will go back to our amortization schedule. Here we will just change this 1 lakh to 2 lakh, and it is calculated. So there, so you are paying 26,185 as your interest and 57,000 as your principal amount. So we will similarly add these amounts into our balance sheet. Here we only need to add year 1 and year 2, because in year 3 it will make the balance sheet go to year 4. So that is what we are not modeling as of now. So we have our interest and principal calculation with us. Let's now calculate the closing balance in year 2. So we have opening balance of 171,495 with us. We are adding 2 lakh worth of loan to our books. So we will add this 2 lakh amount, and we are going to subtract all the principal amount that is paid back. So we are paying back our 1 lakh rupee loan that we took in the initial year, because now it's year 3. So we have to pay that back. We have to pay our 33,000 principal on 1 lakh previous year loan and 57 for current year's loan. So that will give us 1,81,396 as our closing balance of borrowing. And similarly, we will paste this formula in the next slide. So we have 76,814 as our remaining balance of borrowing in year 3, since we are not adding any new borrowings. So now we need to add this closing balance of borrowings to our balance sheet. So we will add this three amounts into non-current liabilities on our balance sheet. So long-term loan in year 1 is 171,495. Similarly, we will copy paste this for year 3. Perfect. Now that we have our closing balance of borrowing with us, we will plug in the interest amount into our P&L statement. So we will plug in this interest from the borrowing schedule. So this will be negative. So in year 1, we are paying 15,000 interest of previous year, and we are paying the current year's interest rate also. So that way we get 28,000 as our year 1 interest. We will now similarly for year 2, we have our interest as these three amounts. Year 3 is also similar to year 2, because we have not taken any additional borrowings. But this is negative in sign. Perfect. So now that we have our depreciation and interest expense, we can calculate the profit before tax, that is EBT, or earnings before tax. So we will paste the formula from the current year's P&L. Okay, so we are at 6,108 earnings before tax, and in year 2 we drop that down to 130, and in year 3 we rise once again to 6,50,000, when both of our outlet are running well and revenue is coming on the higher scale. That way we modeled out both for non-current assets and non-current liabilities. Next we will move on to working capital, which will give us current assets and current liabilities. So let's get on to the presentation. So the first element of working capital is inventory holding. So currently we have around 12 days of inventory on hand with us. We are rising to 18 days because we will enter new market. The sale will be slower on the initial period. So we will have to keep our inventory on hand for longer period. If there are some catering orders that come up unknowingly, so we will have to be ready for that, and for that we will have to keep inventory ready. And if that doesn't get sold, we have to then hold it for longer period. So that way we will then push it to 18 days, since 18 days is a bit more. But in year 2 we are trying to reduce it down to 16 days, and in year 3 we are scaling it to 2 weeks, that is around 14 days. We need to make assumptions based on how we are planning the business to do good or bad, right? So if the business is planned to do very well in the start only, so that way you can reduce your inventory days from current period to less than current period, right? If it is around 12, you can take it to 10 as well. But since sandwich business is something where you will first need to build trust in the market, you will have to build your customer base, and that will take some time. So initially your inventory days are going to rise. Your inventory will not fully get over in same days that you are working around right now. So that way we have scaled it to 18, 16 and 14 days. Coming back to the model, we will now make assumptions for inventory. Now that we have our inventory days with us, so we calculated inventory days on the current period and we got to know that 12.2 is something that we are working at. Now we have 18 with us for year 1, we have 16 and we have 14 in year 3. So we are making this working capital schedules to get the amount of inventory, account receivable and payables that we will have for that particular year. We cannot assume how much inventory we will have in the end of year just in amount basis. We need to think in number of days, which when we will reverse calculate it will give us the inventory amount. So we will see how that is calculated. So we have COGS with us, which we already assumed during the PNL model, which is 5 lakh, which we are plugging in, and we will similarly plug in for next 3 years. We have total days same as 365. Now we have the three elements with us. What is the amount of total inventory? When we calculated inventory days, we knew it was the total number of days in a year divided by inventory turnover, which we got when we divided COGS by number of inventory. So for first year, we had that at around 30, which is 3 lakh divided by 10,000. In this year, since we don't have inventory, we will have to back calculate the total amount of inventory. So inventory equals to. Okay, so this is the formula that we use. But now we don't have total inventory with us. We have inventory days, we have COGS, and we have number of total days. That is 365. So we will take a total inventory on this side and we will shift inventory days to the right hand side. So total inventory then becomes inventory days multiplied by COGS divided by 365. So we will similarly plug in over here. So this is something which you had learned in your schools, like how you can change from LHS to RHS. We will now plug in this formula. So total inventory equals to inventory days multiplied by COGS divided by 365. Perfect. So we get 24,944 as our inventory for year 1. Next, we will copy paste this entire formula for 3 years and we have our inventory calculation ready with us. Similarly, we will do it for account receivable as well. First, we will go to the description. So we have current 70% cash plus 30% on 30-day terms, which gave us 24 days as our accounts receivable. In year 1, we now have more local customers due to expansion of one more outlet in NCR. We are going for food delivery apps as well, which gives us payout in 3 to 5 days period. So for accounts receivable, we have to give an amount of revenue which we are expecting not to be received instantly. We can calculate the revenue receivable from this line. So 30% will be given on 30-day terms and 70% is received instantly. So whatever amount of revenue we are receiving from outlet, out of that 30% will be received in a 30-day period. And on the food delivery app, that revenue is received in 3 to 5 day payout period. So that way we can calculate the revenue receivable, and the number of receivable days that we have is for year 1 17.5, which is around 18 days. In year 2 we are having 13 days, and in year 3 we are scaling it down to 11 days. As we scale to more food delivery app revenue, we are getting less in accounts receivable time. So when we see our revenue mix, we can see that our liquidity position is improving. That is, we are receiving money on a faster basis. So we will once again move to template and see how this can be modeled. Okay, so we have with us the account receivable days for 3 years, that is 18, 13 and 11. This is 17.5. Receivable revenue, this we need to calculate properly. So revenue receivable, we are saying that the revenue coming from outlet sale, that is 12 lakh. We have to take 30% of it, and we have to take entire amount of food delivery app as a receivable. So we will keep this in bracket. So this will give us 8,46,000 of receivable revenue. The total number of days remains same. Now if you take entire amount of outlet in your revenue receivable, then the receivable amount will increase a lot and it will not look good on books. And because it is not the reality, you are receiving 70% of your revenue instantly in cash, that should not be accounted in revenue receivable. So to calculate accounts receivable, we will use the same formula which we used to calculate inventory, which was receivable days multiplied by revenue receivable divided by total number of days. 40,562 receivables at the end of the year. We will copy paste this entire formula first to calculate revenue receivable, and next we will paste this formula to calculate the receivables. So we have 45,000 in year 2 and year 3 as 67,000. So we will now plug in this receivable into our current assets. So for current assets, we have receivable from clients, which we will plug in from here. So 40,000 for year 1, we will copy and paste this for 3 years. So similarly, we will paste for inventory as well. We missed it out earlier. So inventory in year 1 is 24,944 and scale it to 3 years. Right. So the final element of working capital is accounts payable. We will see the assumptions behind it. So number one, currently it is COGS only team is paid early. So currently there are only two payables, which is it could be either COGS, that is all the raw material, and the two staff that we have. As team is paid early on, the COGS only remains as our payable amounts. So for the coming years, when we are going to project how much amount is total payable, which we saw similar for the receivable amount, we will only take the COGS amount. So similar to inventory and receivable, we will have the days we are allowed to pay to the vendor. So in year 1 we are having 20 days, in year 2 we scale it up to 24 days, and in year 3 we are having more days with us to pay the vendors, which is a good thing. As you build good relationship with vendors, they allow you to scale up your payable days, so that helps business to have more cash with them and improve their working capital cycle. So vendor leverage helps us delay cash outflow as we scale. As working capital cycle improves, the cash outflow of the business reduces. So let's now model for payables. So currently we have payable days of 24. That is, we are getting 24 days on an average to pay our vendors. The expense payable, which we are going to take as the COGS amount, because it is the only thing that we are having as our payables. Since all the employees are paid on time, the GST and everything is being paid on time, so we will now start plugging in the numbers. So payable days year 1 is 20, year 2 24, and year 3 30. So 20, 24, and 30. Now we need to calculate the expense payable, which is the COGS amount. So we will plug that from P&L, scale it to year 3. Perfect. So total number of days remains the same, which is 365. And now we need to calculate the amount of payables, which we will use the same formula as we did for inventory and receivables. So that will be number of payable days we are getting for the amount of COGS and divided by 365. So 27,715 for year 1, and we scale it to 3 years where we are at 90,888. We can see that the payables are rising much faster than the receivables. Where we are receiving revenue fast, we are spending it slow as our payable days are increasing. And at the same time, the inventory is also getting cleared faster. So that way our entire working capital cycle is getting better. That is what you need to understand when you are predicting and building a model for future years. So we will now plug in the amount of payables into the balance sheet. So we will directly plug in the amounts. We don't have bifurcation with us. So this is current liability and the amount is 27 for year 1, and it scales to 90 for year 3. So now we have modeled current assets as well as current liabilities. The only thing remaining in the entire balance sheet is the cash element and the equity element. For the equity, we will move on to our presentation and see. So equity funding 20 lakh of angel round that we are doing in year 1. We have retained earnings with us, that is cumulative net profit. No dividends distributed, so all profit is retained earnings, and retained earnings reflect strength and value creation over time. So if your equity is increasing slowly and steadily over year, it means that your business is doing well and operating efficiently. Healthy equity is equals to high solvency and investor confidence. So when you have good equity with you, There are more options available to get in more investment from investors and to scale your business further. And your business is termed to be solvent, that is, it has enough money to sustain in the market. So, modeling out for equity, we will first add our equity funding of 20 lakh. So, this will be, so we already have 50,000 of share capital. Now we are adding 20 lakh to it. So, this will become 50,000 plus 20 lakhs. So this becomes 20 lakh 50,000. For retained earnings, we need to add all the cumulative profits of previous year. So we only have 1 year previously, but before that we need to calculate the profits of the 3 years projection. We will move to P&L. We will calculate the last item, which is taxes. So we have assumed that the taxes are at 20 percentage. Now since in year one there is profit with us, we will calculate the same rate of 20 percentage on the EBT, which gives us 1222. Now net profit after tax becomes, we will copy and paste this, 7300. So this is negative 20%. This becomes 4886, and the profit margins on this are 0. So this is 0.3 percentage. That is almost break even. So when you raised a funding round of 20 lakh in year one, your profit margins dipped very low. That is, you were at 34%, now you are only at 0.3%. This is because increase in SGN expenses, increase in employee and staff salaries. This is because increase in depreciation, because you are adding more assets, you are spending more on interest amount, and all the factors that are increasing your expenses, and the revenue is not growing at the same rates which it was previously, as you are expanding to new area of business. So in year 2, as we are doing loss, we don't have to pay any tax. So that way the tax amount will be 0 percentage, and we will have profits same as our EBT, and profit margins now dip to negative 5.2 percentage from 0.3%. Since in year 2 we are expanding to one more area, now that we have two outlet with us which are new in business and they don't have enough customers, the revenue is not growing very high in number and the expenses are increasing. So that way we now dip into lower margins. And in year 3, when we have sustainable business, we are now doing good revenue, we have already good EBT margins, we will now assume a tax rate of 15% because we have lost credit for the previous year. So over here, accounting standards allow us to carry forward the lost taxes that we faced. That is, when your business was in loss, you can now deduct your current EBT, that is current earnings before tax, from that loss amount and pay lower amount of tax rate. Since we are having EBT of 650, we already had 130 of loss for previous year. We will now assume that we are paying on an average 15% tax rate, reducing the entire amount of 130 from 650. There is a detailed calculation that goes into it, but for this video, for understanding in simple manner, we will just take lower tax rates. So this will be 651 into 15 percentage, which gives us 97,000 worth of tax, and the profit after tax becomes 553. So the profit margins now are at 13%. Now that in year 3 we have good business generated from our current outlet in Delhi, the year 1 outlet is also being settled well because it has been into market for now 2 years, and the second outlet is also growing well. It has also been in market for 1 year. The year 3 is now a compounding year. All the three outlets are now giving very good revenue to the business. Because of that, we are now having 13% profitability margin with us. So coming back to retained earnings, we now need to add all the profits for the previous years and calculate our retained earnings. So for year 1, we will go to P&L. We will take this profit. We will add up year 1 profit, which will give us 346 486. Since we do not have additional share capital with us, we will take this amount, and in year 3 also this will stay at this amount. And for retained earnings, we will add all the cumulative profits of previous year. So this would be year 2 plus year 1 and plus profit after tax for current year. So where our retained earnings decreased a bit because of the loss that we have made, and in year 3 this will be accumulation of all the 3 years profit, sum of all the 4 years, where we have 7,69,000 in our equity as our retained earnings. So that way we can see that in year 1 the equity was similar to current year. In year 2 it dipped a bit due to loss that we made, and in year 3 it is once again going in upward trend as we are stabilizing in our business. So now that we have plugged in all of our line items, yes, this was the last entry. We will now add all the subtotals and the final totals. So this is total of current asset, where we have, then we have total of assets with us, which is total of non-current and current. Then we have total of liabilities, which is current plus non-current. We will just have a cross check. Perfect. And finally we have total equity, which is sum of share capital and retained earnings. Perfect. So now that we have all the totals with us, we will calculate total equity and liabilities. So we have 25,95,696 worth of liabilities and equity, and we can see that the total assets are only 4,68,000. This is because we have not plugged in the cash amount in our balance sheet, and that will be done when we calculate the entire cash flow. So cash flow is what we are going to see in module number 5. So that was it for module number 4. In the first part, we understood the entire balance sheet, taking each and every line item into detail. And alongside, we built the first year balance sheet. And in the second part of module number 4, we created 3-year projected balance sheet using our case study. But as we completed our balance sheet, we saw that our main equation of asset is equals to liability plus equity was not getting tallied. For that, we will have to move to module number 5, that is cash flow statement. So see you in the next one. Until then, this is Karan Damanya taking your leave.